Good afternoon, everyone. It's a great pleasure to be here. Many thanks to Raha for inviting AIMA here today. Hi. And my name is James Delaney. I'm a director of asset management regulation at AIMA, which is the Alternative Investment Management Association. It's a 32-year-old industry group that exists to support and represent the alternative investment community, and in particular, hedge funds. At AIMA, I co-lead our digital assets working group, which is a group that was set up last year, which is really at the intersection of traditional alternative investments and digital assets. It's now one of the largest groups at AIMA, with over 300 senior industry experts from investment managers, allocators, and service providers. We're currently working on a DDQ for digital asset funds, and recently we came out with some new industry guidance on custody for digital assets for institutional investors, which is available on our website if anyone's interested in reading that. So digital assets, as we've seen at AIMA, are becoming increasingly prevalent in investors' portfolio investments. Last year, we partnered with PwC and Elwood to look at the growing interest by hedge funds in the digital assets market. And we've just closed the survey for this year's report. I can't reveal too much ahead of the report's release, which will be in a couple of weeks, but a few top-line results from that survey is that approximately 1 in 3 traditional hedge funds surveyed have some exposure to digital assets. That's compared to 1 in 5 that we surveyed last year. Though the average hedge fund AUM invested in digital assets is 4%, that's compared to 3% last year. The most common primary reason given for investing in digital assets is general diversification. Of the remainder, around 25% stated market-neutral alpha opportunities, and around 15% cited long-term outperformance. Regulatory uncertainty continues to be the greatest barrier to investing. I think that was cited by around 85% of the respondents. The lack of infrastructure or service provider availability also remains a challenge, with audit and accounting now seen as the market infrastructure area being the most in need of essential improvements, which surpasses custody and safekeeping, which was the major barrier to greater adoption last year. And then finally, around a third of respondents not currently investing in digital assets say that if some of those main barriers were to be removed around regulation and the infrastructure stack, they would actively accelerate their involvement or investment in digital assets. So that final report will be published in early June, so please do keep an eye out for that. Interestingly, last year, the digital assets market began to decouple from the long-running dominance of core assets like Bitcoin. An industry focus turned to other emerging opportunities that we've heard from in the previous presentations, so areas such as NFTs, DAOs, Layer 1 protocols, and DeFi. And we're now seeing Bitcoin dominance shift downwards from around 70% in December 2020 to less than 45% today. Our panelists here will consider how institutions are looking at the digital assets landscape, possibly adopting the broader digital asset class, including some of the sort of inherent risks as well. So I'd like to ask the panel to give a brief introduction about themselves and their firms, maybe starting with Sophia.
Hi, everyone. Thank you for being here. It's an honor to be on the stage with the other distinguished speakers from today and yesterday. I'm Sophia Shluger. I'm the managing director for Amber Group here in Europe. Amber Group is a digital assets investment bank. We help our clients, both institutional and retail, access liquidity, earn yields, and mitigate risk in digital assets. We have been around officially since 2017. We currently have $5 billion in assets under management. And we account for about 5% of the daily volume of crypto traded, so upwards of $5 billion a day in Ethereum and Bitcoin in spot and derivatives.
All right, hey everyone. My name is Vays. I spent 10 years in traditional Wall Street environment, companies like Bear Stearns during the collapse, then JP Morgan, a couple of others. Around 2015, I quit to just be a trader of my own portfolio. Also around that time, I started getting interested in Bitcoin, started talking about it, led to a YouTube channel, started traveling the world speaking about it. Today, I still maintain the YouTube channel, has over 100,000 subscribers. Mostly talking about the price of Bitcoin analysis. We also had news shows, law shows, covering all aspects. I also organize educational events, one about just Bitcoin in general as an asset, also one about how to use Bitcoin properly, securing your keys, wallets, how to make transactions, and another one for more traders and funds.
My name's Steve Kurz. I was at the other 2008 blow-up Lehman Brothers, although Bear Stearns got bought, so we can share trade war stories there. But no, spent my first 10 years of my career in traditional finance. It's where I met our CEO and founder, Mike Novogratz. So he saved me from Lehman and introduced me to Bitcoin, which I thank him for both. We started Galaxy in 2017. We're a full-service crypto merchant bank with 5 business lines. We're publicly traded in Canada. I lead the asset management business. We have 18 strategies across different verticals and different exposure types, about $2.5 billion of AUM, and have been at this for 5 years now and watching a lot of what we're going to talk about today play out over those 5 years.
Brilliant. Thanks all. And I think everyone will agree we've got a really esteemed panel here with us today, so thank you. Steve, I guess to kick us off, can you explain a bit about how the digital assets market looks today compared to how it did a few years ago? And given sort of crypto is not just one thing, as was discussed on the previous presentation, can you explore for us the distinction between various digital assets within the digital assets ecosystem?
Yeah, it's a great starting point, and Danny actually did a wonderful job of that, so I'll try not to repeat him. But I think in 2017, when we started Galaxy, there was this real, what is this question? And that was not just about Bitcoin. Is this an asset? Is it an asset class? Is it a technology? Is it all the above? Is it a scam? That was the starting point. And I think what bear markets do well is they really flush out things that didn't need to exist, and maybe we're going through some of that in crypto today. What we saw in 2018 and 2019 was a dramatic flush out of a lot of things in crypto that shouldn't have existed to begin with. But what we saw on the other side of that 2018 bear market was a lot of innovation and building that happened. And of course, the 2 major assets in crypto, Bitcoin and Ethereum, came out of that even stronger as networks, as technologies, and with user adoption numbers going way up, and obviously price following. What we've seen really since May of 2020, and it's thanks to Bitcoin in particular, it started with Paul Tudor Jones really talking about the great monetary inflation and sort of leading institutions down the path of where we are today with these inflation statistics that everyone's following, that got institutions focused on Bitcoin as the fastest horse in the real asset race to protect your portfolio from this imminent inflation threat. What happened shortly after institutions started to look at Bitcoin is if it took 3 years to get sort of comfortable with Bitcoin and custody and what it was to be a Bitcoin investor, it took them 6 months to look at Ethereum with an open mind. And then it took 3 months to think about DeFi a little bit more open-mindedly, and then NFTs and DAOs. So I think you've had this separate parallel system that's been built in a way that integrates with itself, that's nonlinear with a growth curve, and you have institutions that started with Bitcoin and are quickly realizing, holy cow, this is not just one thing. It's not just an asset class. It is a technology. We don't know where all these are going to land necessarily, and a lot of it doesn't need to exist. But some of it really does. And where it does, the total addressable market of those underlying markets, like finance as an example, are really big. Web3, really big total addressable market. So that excitement around those ideas is what we're seeing now. So notwithstanding crypto price any one day, and we'll talk about, I'm sure, what happened in the markets, you just have so much more raw material, so much infrastructure, so much education, and a lot of really smart people and a lot of venture money that are pursuing and experimenting new ideas that will help over 5 to 10 years this global generational trend towards digitization and blockchain technology.
Thanks, Steve. Sophia, I guess, what are some of the major trends that you're seeing in the digital assets ecosystem, and how are institutional investors getting exposure to this new asset class? And then a final question, do you see on the horizon a sort of big ticket allocator looking to invest in digital assets?
Yeah, absolutely. So I like to quote Schopenhauer, who said that truths follow 3 phases. The first one is truth is ridiculed. The second one is that essentially, if I forget what it is, it's violently opposed. And then the third one is that it's basically determined to be self-evident. So I think we're at between phase 2 and 3 at this stage. I think everyone's realized there's an inflection point in the institutional market with big players like BlackRock coming in. You see a lot of companies like MicroStrategy, Tesla, Galaxy putting Bitcoin on the balance sheet. We service 1,500 institutional clients globally. Everything from hedge funds, high-frequency trading desks, quant funds, family offices, and other high-net-worth individuals. And generally speaking, obviously, they're looking at the more liquid names, always Bitcoin, Ethereum. And I think a lot of the players have come out initially just trying to get exposure synthetically. That said, as time has evolved, we've seen 2 to 3 times as many institutions onboarding now this year than last year. I would say that's previous to this Luna Terra debacle, unfortunately. But generally speaking, I think there's a lot of interest. There still needs to be a lot of education, however. And we just recently put out an asset allocation report where we surveyed different managers who've looked at how to allocate it into a diversified portfolio and actually improve your risk-adjusted return. So, I think the inflection point is here. We are seeing a lot of different entrants, get up to speed, educate themselves, and play in the space. I think post the recent Luna and Terra incident, essentially what we're seeing is a lot of those clients who used to be trading on exchanges rethink whether or not they want exposure to an exchange, and they want to do it with a secure partner like Amber Group, where effectively they can get the same exposure, they can use sophisticated tools like hedging and trading perpetual swaps, et cetera, but they can do it in a lower fee manner. And so I think as more products come to the market, as the education improves amongst different institutional players, I think we're going to see more and more come in.
Thanks, Sophia. Digital asset managers, I guess, are turning their focus to some of these emerging opportunities that we've talked about. What does that mean for sort of the core digital assets? As I mentioned, sort of dominance is going down. What does it mean for Bitcoin?
Well, yeah, that's a really good question. So right now, we're really living in a world of the chasing yield. We saw this in 2005-06, where, institutions already had no choice. Like, they had to participate in this crazy real estate market, even though a lot of them knew that it was a bubble. But then their competitors would completely outpace them, and then you won't even have a business, and then everyone collapses in a group thing. And Bitcoin is seen as boring, old, slow technology. But that is one of Bitcoin's strengths, is the fact that it's underlying core stability. And ever since Bitcoin came out, after a couple of years, there were clones of just Bitcoin. Then the idea of, well, it needs to do more. So Ethereum came out. Yes, it's exactly what Bitcoin is, plus this layer for smart contracts. And then a bunch of Ethereum copycats came out, which is what all the other blockchains are. There's just going to be a better Ethereum, like Cardano, like Solana, like many, many others, because Ethereum captured the ICO space back in 2017. And again, it was, hey, so it's everything that Bitcoin is, which is currency. And then plus, we're now going to be a security as well. But because we are a currency and a utility token, then we're not actually a security. That bubble kind of busted. Then we had DeFi. OK, so it's everything we had before, but now there's also some yield involved, some yield farming. We're just going to create more token. And then that kind of started going away. Now it's NFTs. So it's everything we had before, but now it's also like this unique digital token. And I always say that, well, if you have infinite amount of unique tokens, is it really a unique token? Because they're all free to create. It is free to create digital data. And a lot of it's going to go up and down. To me personally, what happened with Luna is more the norm than the exception. It just hasn't happened as often, and we'll see if it still does. What does it mean for Bitcoin? Well, Bitcoin's dominance versus everything in aggregate is probably going to continue to drop. But Bitcoin's dominance versus any single other project will continue to increase. Basically, it's kind of hard at this point. Well, the internet, people could never profit directly from the internet. The internet itself was never monetized. So you could only profit from the internet by picking the right companies that utilize the internet to do business. If you picked wisely, you were in Amazon. If you didn't pick wisely, you were in pets.com, even though it was exactly the same company. They just started with different products. But with Bitcoin, you can profit directly from the internet layer itself. That's Bitcoin. And you don't have to choose winners and losers, but obviously, if you choose wisely, you're going to make a lot more money in the short term. If you choose poorly, it's going to be what happened with Luna. So that's kind of my view on Bitcoin. It will outperform any single asset, but not in aggregate.
Thanks for that, Tone. Steve, I guess I just got back from the States. I'm thinking in baseball terminology, but a lot of people say we're not in the first innings, we're still in the parking lot when it comes to institutional adoption. I guess, is that how you see where we are on the adoption cycle and in terms of the institutional interest in this asset class? And also, which institutions are we really talking about when everyone says institutional adoption?
Yeah, I think this is one of the most misunderstood and overly sort of discussed, if even our founder sometimes goes out and says the institutions are coming, which institutions and what does that mean? So when I think of institutions, I think of the institutional allocator community. That's $100 trillion plus, and it's a market that broadly hasn't yet come into crypto in size. You have some examples of endowments and foundations and other forward-thinking smaller institutions that have adopted things like a venture bet or a Bitcoin bet. But broadly speaking, that entire community hasn't yet put money to work in crypto. That does not mean we're in the parking lot for that particular group of institutions. One of the things that most people don't realize, all the gatekeepers, the consultants, right? 3 years ago, 2 years ago, 1 year ago, crypto, Bitcoin specifically, but certainly the rest of crypto, was not investable from the perspective of the average ODD person at a consultant. That was partly because of service providers, that was partly because they weren't up to speed, that was partly because of volatility and regulatory concerns. Today, that's fundamentally different. At Galaxy, we've gone through multiple consultant processes earlier this year. I can't tell you in a month that means that the pension money is going to come in, but I guarantee you that in a year that will mean that. That's just how this works. And so the wheels grind very slowly, but it's not linear once they grind. So it's not going to be $10 billion and then $11 billion and $12 billion. It's going to be a few really blue chip leading players in the space backed by consultants. And then you're going to have essentially this herd mentality that makes it okay for their peers to come in. That's going to happen over the next 12 to 18 months, the same way we saw institutional wealth come in 2021. In January of last year, no bank platforms had crypto products on their offering list. Now, almost all of them do. That required ODD work, that required institutional adoption and processes from a risk perspective, from a legal perspective, and from a product selection perspective. There's a parallel to that to the allocator community today. Just last week, in the middle of all the chaos, multiple large pensions came into our office and they said, this is what we've been waiting for, to sharpen our pencils. Not to buy the dip, but to start to go in at more sane valuations, to be able to pick apart what's actually got enduring value and what doesn't, and to make bets with key strategic partners. So I'm very bullish about that story, even in the midst of all the volatility that we're seeing.
Thanks. You're talking of volatility, I guess, Tone, to some investors who have more recently started looking at this asset class or have invested, what would you say to them to sort of calm their nerves around the latest volatility or correction? Whatever it might be.
Well, it really depends on which asset they bought. We'll start with Bitcoin. If you did invest heavily into Bitcoin, whether you're a corporation, whether you're just a person, individual person, whether you're a government entity like El Salvador, you have to be strong enough and in that position to weather the storm, and the storm could last a couple of years. So it is unfortunate for the government of El Salvador right now that they are down on that position and the world sees them as potentially making a mistake. But within a few years, as long as the government isn't overthrown and the government remains in power, they will be seen as geniuses. Same thing for any CEO. Michael Saylor is in a position where he's not going to get removed as CEO. So he can weather a multi-year storm of hate for his decisions. And I'm very confident his decisions are going to be proven accurate because just like when I go to sleep, I feel that the most comfortable asset in my portfolio is Bitcoin. That's the one makes me sleep most comfortable at night because my view that Bitcoin is risk-adjusted, the safest asset in the world, especially when you're holding on to your own keys. It makes it the only censorship-resistant and unconfiscatable asset in the world because anything else could be taken away from you by the wrong people that don't like you. Now, if you're holding another crypto asset, again, you have to weigh the risk versus reward versus return. And I think everything else in crypto is significantly more risky, almost infinitely so, because I don't see anything else as decentralized as Bitcoin. And decentralization is a strength. It's also a bit of a weakness. So if you are in any other asset, you have additional risks, especially regulatory risk. is significantly greater because that asset could be deemed potentially a security, even though that has not been happening and the SEC has not been doing much. So that risk is kind of mitigated a little bit, especially if Ripple wins the case against the SEC, then the whole world is up for grabs. But there's also lots of technological risks, as we saw with Luna. And as long as you don't have too much weight to those assets, you'll be fine. But you have to understand fundamentally as to why you're holding that asset and what your time horizon is. Bitcoin has a very long time horizon. That's what gives it strength. All these other cryptos, the newer it is, the shorter your time horizon should be. So for anything else, as long as your time horizon is accurate, hey, I'm only entering this for a short amount of time to get some gains, and then I plan to sell it, then you can do well, especially if you understand when it's being pumped and who's in charge of these projects.
The other thing I'll mention is we've mentioned volatility in digital assets, and I think it's important to remember it's been around for many years now. However, as more and more institutional players come to the market, liquidity improves. We do anticipate that the yields will compress and the volatility will subside. At the same time, you've got a derivatives market that's growing, becoming more and more liquid. And so there are ways in which potentially to hedge your exposure, to monetize those assets, not just by holding them in a wallet, but also by, staking them or buying into, some structured products or fixed or flexible yield products. So there's multiple ways in which to obviously monetize your investment.
Yeah, real quick, there have
Go ahead.
There have always been short-term, very high-yielding assets. When I started out as a trader in the early 2000s, I remember some people were trading penny stocks all the time. And something that never interested me. But the gains you can make there are incredible. But today, in a world of social media and Twitter and such easy access to a global audience, the crypto space, to me, is the equivalent of penny stocks, with an incredible reach with influencers. And that's why the valuations get so high. But just like back in those days, you don't expect a company whose stock is worth a couple of cents to be a better Google. I don't expect a lot of these new projects that are coming out to be a better Bitcoin.
Yeah, look, I mean, we've obviously got a Bitcoin, proponent, and I love Bitcoin. I think the other side of this, and it's a great time to have the discussion. From our perspective, there's things you should throw in the trash can, which is a lot of what Tone is talking about, and we agree. 20% yields on an algorithmic stablecoin, if it seems too good to be true, it's probably too good to be true. There's what's investable today, which we think is for sure Bitcoin and Ethereum, and then there's this middle experiment box, which I don't agree is totally, without value, right? DeFi is a sandbox. I think there's potential value there over time. But it's really important to know what game you're playing, right? To the extent that you are in an algorithmic stablecoin because you want to get 20% yield and you think it's the same as a dollar, that's a real, looking at this now, that is going to affect a lot of people. 40 billion is a huge market cap to be wiped out in a week, and we think that's obviously terrible. I think that there are more use cases that are evolving, and it reminds me of 2017 and 2018. There will be something that comes out of this bear market that's going to have value that we haven't thought of yet, which doesn't take away from the Bitcoin value proposition and isn't just a penny stock in my view.
Thanks, Steve. Sophia, coming back to sort of that institutional adoption discussion, sort of what are you seeing from investors in this space in terms of what their actual interest is in digital assets, what's sort of grabbed their attention, and what do you think will drive institutional adoption going forward?
Yeah, absolutely. I think if you take a look at the venture capital market and you think about the fact that $10 billion worth of investments were made in the first quarter of this year alone, which is double the same time last year. It is quite eye-opening, and I'm reiterating what Dan Moore said earlier. Pension funds are starting to allocate 10 basis points. They're starting to learn about it. They're starting to allocate very small, but the biggest hurdle is that first allocation, right? From there on, you can expand your allocation, into a higher ticket. Just reiterating what I said earlier, I think there's a camp of investors or potential clients out there that haven't done enough reading or education. They're still on the sidelines. They believe, there is a great opportunity. You can't ignore a $2 trillion asset class. But I think a lot of institutions don't have the investment mandates yet, or they're more comfortable getting synthetic exposure. Whereas what we specialize in is really spot exposure and the ability to sort of implement your investment view without having to pay the fees that perhaps you would pay if you went into more of a synthetic product. So Generally speaking, I think also what is really captivating a lot of people is the fact that Web 3.0 is here, and the metaverse is a $13 trillion opportunity, right? I mean, we have a 100-person metaverse team. We are launching Openverse, which is a Web 3.0 platform to allow businesses and communities to engage in the metaverse economy. And so at Amber Group, we take a much longer view on digital assets. It's not just crypto asset trading. It's not just, monetizing your data and investing in this asset class that can provide very high risk-adjusted returns. It is all about being positioned for the future and to be able to have an account and a platform which is your one-stop shop to really participate in this Web 3.0 economy that's coming. So, I think all of these different components of digital assets, whether it be NFTs, DeFi, and the metaverse, it's coming, and it's coming very quickly. And so, that is why we are so focused on being positioned, so that when clients are ready and want to interact in Web 3.0, in the metaverse, want to participate in DeFi and NFTs, we're positioned well to service them.
Yeah, I think historically it's been a barbell, right? It's either passive exposure or venture exposure, and then there wasn't that much in between. The raw material, not just of the palette of crypto, but of the palette of product structures is also really important, right? The fact that you have a futures Bitcoin ETF allows you to have a basis opportunity. There certainly are ARB opportunities around stable coins, and forget fundamental value for a second. I'm saying these trading strategies 4 years ago didn't make any sense when you talk to an investor, but that hedge fund ecosystem is growing rapidly. We track this in our fund of funds business, and there were about 800 crypto funds a year and a half ago. We now have 1,900 crypto funds. So just in terms of the breadth, the depth, again, that doesn't speak to any one coin or any one theme, but you see talent, you see capital, you see different strategy verticals. That's what institutional allocators need to put into a bucket. It's really hard to think about where all of this goes, but you could put Bitcoin in a real assets or macro hedge bucket. You could put a crypto hedge fund in a hedge fund bucket, Ethereum maybe in an equity bucket. And so you're just getting more options that come along and allow you to actually make that final step and put money to work in that context.
I was going to just say one other thing in terms of data. I mean, what we've seen recently is that 1 million worth of Bitcoin is in the hands of institutions, or about 5% of issued supply. Fidelity came out with a research report saying that 80% of institutions believe that digital assets have a place in a diversified portfolio. And we also see data that shows that family offices, about 30% of them in Europe and Asia, have some sort of exposure to digital assets, whether it be indirectly or directly through venture capital investments, et cetera. So there is a lot of interest there. The exposures are growing, and it'll be interesting to see how, as we come out of QE, how the market evolves.
For sure. I think, Steve, looking a bit at sort of risk management, and we've talked about Terra Luna, the capitulation, and caught a lot of people off guard. Sort of when looking at the sort of diversifying beyond Bitcoin, the other opportunities, sort of, and maybe DeFi specific risks, sort of, what do you look at? How do you sort of mitigate against such risks?
Well, there's a couple of risks, right? There's smart contract risk. Anytime you move assets on chain, that is something that can be exploited. All of this is very public, so to the extent there's a problem with the code, it can be identified very quickly, and it can be, you can have pile-on attacks. You could have protocol level risk, right? And every stablecoin issuer is really a counterparty. And when you look at what happened with Terra, again, if it's too good to be true, it's probably not what it seems. And so this idea that they are able to support 20% yields, when in fact on the other side of that trade it was actually only an 8% interest that they were paying, there's a huge imbalance there. And it doesn't take that much risk capital to actually throw that off. I mentioned the ARB opportunity, right? You don't need billions and billions of dollars of risk capital to force that system to unwind itself. So from our perspective, know what game you're playing for sure, but also, algorithmic stablecoins are an experiment, right? I remember my buddy who runs a VR company called me a few months ago. Why shouldn't I put my corporate treasury, the dollars that I have, into Anchor and get 20% return? And it's like that's horrible risk reward. Why would you risk 20% when you could lose 100? So fortunately he didn't do that, but unfortunately a lot of people didn't know what they were actually putting their money into. I think that's very different than, for instance, an over-collateralized algorithmic stablecoin like DAI, where they're not actually chasing growth the same way the Luna Terra ecosystem was. I think it's very different than Circle, which is verifiably dollar-backed and has a real use case within and around the crypto exchange ecosystem. And so I think, if you're an institutional investor, really you shouldn't be putting dollars into experimental tech, which for sure algorithmic stablecoins are. You should be watching and making sure that these things are robust. You should have partners who tell you these things before you put money to work. So it's really some of the basic lessons. And when you have, to Tone's point, one of the great strengths of Bitcoin is that, no one knows who created it. I think that's a huge advantage compared to the Luna ecosystem, where you had a young guy who was cocky and thought he was, God over this economy, and look at what happened, right? So in retrospect, it was very obvious, but I think, you need to really do your work before you put money into different pockets of the space.
Thanks, Steve. Tone, I just want to switch across to another area, ESG, which is one of the fewer teams at AIMA that's bigger than the digital assets team. Obviously, the rise in popularity of Bitcoin has shone a light on some of the environmental factors. Some people, quote unquote, say it's bad for the environment. I suppose, how do you respond to that particular question as investors are looking at the sort of green investing versus digital assets?
Personally, I think the ESG initiative is totally insane. That's my opinion on it. Having said that, I think Bitcoin itself is probably the most ESG asset in the world, because first of all, by investing in Bitcoin, you are investing in basically sound money once again, and it actually makes you want to defer immediate spending of your money and actually become a saver. So you start actually spending less. And this view that Bitcoin is, destroying the environment and taking up energy, it's completely misguided. Michael Saylor has done great work to combat, this push to make Bitcoin sound like it's destroying the environment. But even entertaining the idea that mining Bitcoin is bad for the environment is silly, and that's one of the reasons why several even friends of mine have been giving Michael Saylor a hard time over it. The reason why we're all sitting here today is because we use energy. If you really, really care about ESG and you didn't walk to this room, you could have swam across the Atlantic. That's really the only way, because even if you cut down a tree, you're destroying the environment, right, to build a ship. So the use of energy, helps humanity. It doesn't hurt it. And Bitcoin removing the ability of governments to just print money at will should make the world a much better place, hopefully eliminate a lot of wars as well as that is happening. So that's kind of my view on that, and I think Bitcoin will also, because now there is this incentive to get the cheapest source of energy and directly monetize the cheapest source of energy through Bitcoin, that the innovation that will come because of capitalistic incentive to mine Bitcoin is what's actually going to revolutionize the capture of energy and make it better for the entire world. And it's really sad that Bitcoin gets demonized due to the ESG initiative.
So I agree that it's sad that it's demonized, but I actually have a slightly different view that it's a false choice. And I want to shout out, we have our head of mining here, Amanda, and our head of investor relations, Elsa, and they are literally the world's experts on this. And so at Galaxy, we're part of the Bitcoin Mining Council. I think they'll correct me on the stats, but somewhere between 50 and 60% of that collective, which is a huge portion of the market, is already sustainable energy. And at Galaxy, I think we're up to 80%. Something like that. So this is already changing, and so that makes the narrative ring even more hollow, in my opinion. You don't have to choose, and I think Bitcoin's going to get to significantly higher levels of sustainable energy behind it, well ahead of other industries, and I think that's a really important story that we need to tell and be intellectually honest about.
Oh, I should have probably, before I answer the question, I probably should have said before I started working on Wall Street as an engineer, financial engineer, I did get a degree in geology. So that's what I kind of started out. That was my first career.
Nice.
On the ESG side, I'll say that at Amber Group, we take corporate social responsibility very seriously. We've actually adopted a whale named Salt in the Pacific Ocean through the Whale and Dolphin Conservatory. We have plans to adopt more whales because they are a very important part of the marine ecosystem. That's not a joke. That's actually true. And we also have a partnership with Moss where we have bought $2 million worth of carbon credits to offset mining trade. So being a sustainable long-term business, but being crypto native and focused entirely on digital assets and everything that will come thereafter is a core part of who we are.
Thanks, Sophia. I guess a final few questions, and then maybe a few minutes for the audience to ask a couple of questions. But Sophia, when deciding where to allocate, sort of what should investors be considering, and what do you think the digital assets ecosystem is going to look like in the coming years, sort of next 5, 10 years?
Yeah, absolutely. So in that asset allocation report that we put out, we've surveyed a bunch of managers and research houses, and have basically seen that an allocation between 1% and 2.5% in a diversified portfolio that's 60-40, equities, fixed income, has actually improved risk-adjusted returns over time by a good margin. So there is a lot of literature out there that talks about what is an appropriate allocation into digital assets within your alternatives portion of your portfolio. So I'll be happy to send that report to anyone to have a look. In terms of the future, I alluded to it earlier, NFTs, we're really excited about DeFi with NFT integration. We have a principal investment group where we've led financing rounds at the likes of 1inch. We've invested in Near Protocol and Arweave. We're very passionate about DeFi and in particular the infrastructure side of it. And so we're really excited to see innovation in cross-chain interoperability because the infrastructure of the future financial services market is being built right now. And so I encourage anyone, if there's one takeaway from this panel that I may leave you with, it is that we at Amber Group believe that digital assets will be the most important asset class of the future. There's a lot of innovation happening, there's a lot of investment pouring in, and there's a better way to transmit value between parties.
Yeah, I think it's pretty simple in terms of getting off of zero, right? The world, if the world's around 400 trillion in overall economic activity, the crypto ecosystem, depending on the day, which today is lower than a week ago, is between 1 and 2 trillion. That's between 25 and 50 basis points, just as a benchmark. If you're an institutional allocator and you haven't yet taken a position in crypto, you're short, just inherent in that math. So that's okay to be short, but no choice is a choice. And so we think you got to have Bitcoin, you got to have Ethereum exposure. And then to the extent you believe that these stories can disintermediate those large TAMs, so I don't know if DeFi will take over traditional finance, but it has a chance to. If you're an allocator, you have a lot of exposure to traditional finance. If you believe that Web 2 is suboptimal to Web 3, that's a very big TAM, right? You should have a small piece of your portfolio there. So we think of it much more as a hedge and a sizing exercise and a diversification exercise in terms of how you make your first move, and then you have to follow the story as this evolves and make sure that you keep on top of a very fast-moving space.
Yeah, I just want to add something real quick to that. And you have lots of choices to choose from in the crypto ecosystem, but the way I like to separate them is, again, Bitcoin is like the underlying layer, like the internet itself. And to me personally, I always saw Ethereum more as a corporation with a leader, CEO, versus Bitcoin, which is a decentralized protocol nobody controls that barely ever changes. While something like Ethereum could, move fast and potentially break things, though they haven't broken it yet. But the risk there is significantly higher because of its faster advantage. So there's nothing wrong with investing in these other crypto projects, but to me they're akin more to like companies, and you're investing in a company versus investing in an actual protocol. So as long as you understand the difference in risk and reward, then start due diligence from that standpoint.
Excellent. Well, I think I'm being told time is up, so we'll wrap it up. I just want to say thank you very much to our brilliant panelists today, Sophia, Tone, and Steve, for sharing all their insights with you. If you do have any questions, have we got time for questions?
We have a few more minutes, yeah.
Does anyone have any questions in the audience? I had a question. We do. Excellent. Thank you.
Yeah, hi, Patrick Martin. I run a family office here in London. Question for you, Steve. So the market disruptions that happened last week, so you think that this is more an opportunity for institutions to come into market than a block?
Than a what, sorry?
Than a roadblock that they basically say, oh, this whole system is broken, we shouldn't touch it.
What happened was you have a macro environment and crypto has been a risk asset that knocked crypto down, and then there was an idiosyncratic event on top of that. So it was a 1-2 punch for sure. I'm not diminishing. $600 billion of market cap wiped down a week is significant. More, it was a comment of, first of all, we need to assess the fallout, which I think you will have some fallout across the crypto ecosystem from this. But in terms of those core positions like Bitcoin and Ethereum, this will be a very good buying opportunity in our perspective. In 24 months, I think Ethereum will be way above $2,000. I think Bitcoin will be way above $30,000 for both adoption reasons and also macro reasons and also technical reasons. And I think, even on a price basis, if you look at Bitcoin over the weekend, there were macro funds lining up to backstop the market if it was a 24K or a 23K situation. They didn't have to do that, but that's very different than the last time Bitcoin went down this much. You didn't have all of this interest, education, buying power in the wings, so to speak. So I think it's a very different bet, and the skew of Bitcoin is really good from here. And as it goes lower, I think it's a good time to sort of buy the dip systematically.
I'll try to answer that slightly differently. To me, it just shows that if you're not going to be Bitcoin only, then you need to significantly diversify. You cannot pick and choose winners and losers in the crypto space other than Bitcoin. Like, even if you're going outside of Bitcoin and into Ethereum, that Ethereum part should probably be diversified across other things, including Ethereum's competitors. But if you're going to go into Bitcoin only, then I don't see a need for diversification within the asset class, because if Bitcoin dies, all of this dies. But if one of these other projects, including Ethereum, fail, then it's like, oh, we'll just use Cardano. So either it's Bitcoin only or full diversification across the spectrum.
Sophia, anything to add?
Oh, I mean, if I'm not mistaken, El Salvador announced that they bought some more Bitcoin, at these levels, because again, as you're alluding to, like, the thesis is there. They bought into this for a specific reason, of which I think a lot of us understand. But no, generally speaking, I think, even Coinbase published an article recently saying that, like, in the last quarter, a third of the trading activity was retail, and then the lion's share of it was actually institutional-led. So I think we're starting to see more and more of institutions taking the lion's share of the trading. But yes, this is a hiccup. It's a significant one. I think people are going to take some time to assess. But let's remember, the traditional asset classes have also taken a huge step down. I mean, I still invest in traditional assets, and I'm very concerned about what's happened with some of the blue chip names in the NASDAQ, right? I don't recall seeing this much volatility in such a compressed time period since the previous financial crisis. So there's a lot of different headwinds, whether they be geopolitical, macro, inflationary, et cetera. I think we need to piece apart, fact from fiction, and again, reassess once the market cools down.
The final point I would make is, if the Fed does in fact pause, which I think is a possibility, I think you can look to crypto as a breakout asset to the upside. You can't ignore the macro picture in all of this, obviously.
Thank you so much.
Question here.
I'm so very pleased to be here. So very delighted with your new industry.
A little closer to the mic.
In order to kind of globalize your industry much more quicker and exponentially faster, wouldn't you think of like setting up joint venture funds with, let's say, data centers, operators, or mining core centers companies, in order to institutionalize the business, like the industry, much more faster, and bring it further?
We do that every day in Amanda's business and the mining group at Galaxy as well. Totally agree. Yeah.
We have a mining business as well. We have a site in Ohio that we've developed. We host miners there, and we have a dedicated team looking at opportunities globally to develop mining sites. So it is also part of our business, and obviously we want to be as integrated as possible in the digital asset ecosystem.
Yeah. So the mining point, but also, and the crypto community doesn't like this piece of it, but we're very focused on an ETF in the U.S. for Bitcoin. We think that the structure, while it's not the wrapper that we want, we love for everything to be digitally native, could unlock tens of billions of dollars into Bitcoin. We're partnered with Invesco to do that, and we're really excited about that when it happens. So we're working with the regulators in the U.S. on that as well.
Thank you so much for all the information and knowledge. I have a quick question regarding what happened with Luna last week. When we look at institutions who have big teams to actually look at these types of projects, we see that there was some institutions that led the rounds, the VC rounds around it. There was founders of major institutions that were big fans of the projects only a couple of weeks ago. And it seems that now everybody looks at it and says, well, we kind of predicted it, it would have happened, etc. So I'd like to know in the kind of the thought process, at which moment was there actually red flags, and at which moment it feels that, a few weeks ago, probably a lot of people would say, hey, this is one of the top 10 projects, which was in market cap, but today it seems that it's a total 180. So how did that kind of thought process come along over the last few weeks?
Yeah, sure. So from a fiduciary perspective, we run an asset management business. We're SEC registered, and so it was very. We have a Bitcoin fund, we have an Ethereum fund, we have a Solana fund, right? We never had a Luna fund. There wasn't qualified custody. He does have a tattoo. He does have a tattoo of Luna. We didn't launch a Luna fund. That's my point, right? Mike was a big believer in Luna. And Mike's a trader. I've known Mike for 15 years, right? When something goes up a lot, Mike will take risk off. That's what he does. And Mike also, makes a bet here or there, and he likes tattoos. And so, that's what happened there. I mean, look, we thought Luna was a really interesting experiment. It's unclear if there will be an algorithmic stablecoin that works, but it's certainly not the same as making a Bitcoin bet on behalf of your client capital. That's a very different thing than a proprietary position. The position Mike took in Luna last year was a proprietary position, and we have a greater standard of care for our client assets.
Yeah, I want to try to answer that question again a little bit differently. But yeah, I know Mike as well. If you Google my name and his name on YouTube, there is a pretty funny song about
that loops for 2 hours straight.
Yeah.
You have to listen to it. Their heads are spinning. It's weird.
And so my view is slightly different. So the world is changing a lot. And the biggest thing in this digital world is the future might be that, back in the day, you'd have to have a company, you'd have to have like private seed rounds, but eventually before your company has a publicly traded asset for global price discovery of said asset, you needed to actually have some kind of a business and some kind of revenue. You may not have profit. Facebook, God knows how long it took them to have a profit. You may not have profit, but you need some kind of revenue, you need customers, you need some kind of a business. Bitcoin changed that, right? Like the current, and mostly Ethereum has changed that. The world right now is the asset with free market discovery of its price happens first. And then the business may or may not come later in some future. And the VCs love this model because they get to get in and out very, very early. And the question is this going to be our future? Because if it is, the old model of going public on the stock market after your business has evolved is gone. The future would be 1 billion tokens. And let's see who the winners are. And that could be the future. I'm not going to say it's a better future, but it could be the future you may have to live with because potentially that's where we're going. The asset comes first, and they make a bunch of money, and this is why I'm still like exchanges. Like I've always been critical of Binance, FTX, because they have a token. And that token gave them a competitive advantage over their competitor exchanges that did not fundraise through a token. And somehow 300 years of exchanges didn't need tokens, but suddenly Binance has changed the way it's done. And you have to compete. So you have to do that as well. So potentially that is the future, token first, and then see what business can happen then after. As long as you understand that's the future, it could be the game you have to play going forward.
Great point raised there is that, we didn't mention it, but the tokenization of real assets is coming, right? We still have T+2 settlement. Now we can have T+0. That is efficiency improvement. That is progress. That is innovation. So all of this is coming. At Amber Group, we also are a designated market maker for token issuers, so we actively distribute tokens across exchanges, but we are very careful to look at tokens or projects that have real utility and use case. And it's only being positioned in the center of the digital assets ecosystem and understanding what are the problems that are being solved in DeFi that we can assess and understand what projects have value and where DeFi is going. And that is insight and value add that I would say a lot of other players in the market don't have.
Thanks for that. I think we're going to have to call it a day there. So thank you again to the fantastic panelists, Sophia, Tone, and Steve.